we have returned to a situation of kind of long run lower prices, prices that are sort of near what I would call normal levels when the market's reasonably well supplied. Every once in a while, stocks get tight, supplies get scarce, and prices rally. That's what we saw a couple of years ago. Now we've kind of returned to back to normal. That's a more challenging environment for farmers. And so risk management is really critical in times like these. I think the one thing to recognize with grain markets is that grain marketing is a really difficult challenge. We don't see that, you're not going to get it right 100% of the time. That hindsight is 2020 for sure. And so not beating yourself up if you miss that big rally, but giving yourself the opportunity to take advantage of market rallies when they come along. We've seen, for example, corn prices appreciate reasonably significantly between September, October, and the end of the year now. That's an opportunity, a marketing opportunity, and you want to take advantage of those when they come along. We know that farms hold a lot of grain in inventory at the end of the year, right after harvest. And the question is, what do we do with that? We've done some work at University of Illinois with members of the Farm Doc team to think about how farmers use grain storage. And the really important thing is to understand the costs involved in grain storage. One of those are sort of physical costs, the things that you really see. The cost of the grain might deteriorate in the bin. You got to keep it in good condition. You have to move it in and out. But the other costs are a little bit more hidden. They're opportunity costs associated with not getting paid for grain that you might deliver later in the year relative to getting paid for it today if you make that sale right now. So understanding your own cost of capital, are you a little bit more cash constrained? That's going to kind of make storage look a little bit less profitable than if you don't need the cash right now.